The Australian dollar rallied above 80 cents this week for the first time since January. But will it be sustained? We have our doubts. Key positives supporting the Aussie have been a bounce in iron ore prices, some doubts over the RBA's rate cut outlook, and also some softness in the US dollar. On the iron ore side, the rally extended to 27% over 3 weeks during April. But since then, we've seen a 6% drop in the headline iron ore price. And indeed, we do have our doubts about the sustainability of the rally, given that ongoing supply of iron ore into China is still very substantial and growth in the Chinese economy is still reasonably sluggish. So we don't see this producing further sharp gains in the Aussie multi-month. In terms of the domestic outlook, the strength in the unemployment numbers and slightly higher than expected inflation numbers saw doubts over whether the RBA would cut rates in May. This brought the pricing down to about 50-50. However, the very fact that the Aussie dollar rallied above 80 cents added to the case for the RBA to cut rates on Tuesday. Westpac continues to expect that the RBA will lower interest rates next week and back it up with a cut in their growth forecasts in Friday's statement on monetary policy. Pricing for the Reserve Bank's decision on Tuesday has increased to about 70% chance. Should we see the rate cut being delivered as we expect, then there should be further selling of the Aussie, albeit perhaps not dramatic. As to the impact of a softer US dollar, all major currencies rose against the US dollar over April. We've seen a number of weak data releases out of the US, particularly including the soft Q1 GDP headline, which was just about flat on the quarter. This reinforced the Federal Reserve's decision to be wary on the outlook for interest rates. It's not ruling out a move as soon as June, but that does seem unlikely. September looks a far more probable date for the first Fed rate hike. As such, the US dollar is likely to remain reasonably under pressure near term, and that's likely to limit the downside to the Aussie. Given this, while we do think that any further probes by the Aussie dollar above the 80 cent level are very unlikely to be sustained, we only see it down to about 78 over the month ahead. As for the Aussie Kiwi exchange rate, we now suspect that a dip below parity is quite unlikely. This week we heard from the Reserve Bank of New Zealand taking quite a different tone on the outlook for interest rates, being very explicit about the possibility of a rate cut in the months ahead. It's certainly not a done deal that the Reserve Bank of New Zealand will cut rates, but the markets are likely to ponder the probabilities in the coming weeks, and that should undermine the Kiwi and ensure that the Aussie-Kiwi exchange rate doesn't dip below 1. In the week ahead, there's a great deal on Australia's calendar, obviously highlighted by the RBA decision on Tuesday, but we'll also see readings on building approvals, trade balance, retail sales, and most sensitive for markets, unemployment. The March unemployment survey was very encouraging, including upward revisions to job creation. If we get further strength in this series, it's likely to reinforce that the RBA won't be in a hurry to cut rates again, assuming that is that they do so on Tuesday. We'll speak to you next week.